I have been swing trading for years, but I've always felt like I was missing something. I'd catch good moves, lose them, catch a few more, get chopped, until one day I noticed a pattern on the daily chart that completely changed everything. Today I'm going to show you that exact daily plus 1 hour setup that finally made swing trading make sense. If you've ever felt like you entered too early, exit too late, or just never catch the big moves, then this video is the video that fixes that. Most swing traders get wrecked for the same reason. They try to trade the 1 hour, 4 hour, or 15-minute without understanding what the daily is telling them. They're trading inside randomness. They're buying inside premium. They're selling into demand. And then they blame the strategy or they blame themselves. The daily time frame is the only time frame that reveals where the real liquidity objectives are. And once I understood this, swing trading became mechanical. Here's what I found. The biggest, cleanest moves in the market only start after one thing happens. A daily liquidity sweep followed by a daily candle that is engulfing. That was the missing piece to my puzzle. And once I learned how to read these shifts, every big swing trade suddenly made sense to me. Now that is what this video is going to be about. We're going to uncover step by step the model that I've discovered after years in the market, and you will be shocked how simple it is. In this video, we're going to talk about external to internal liquidity and vice versa, internal to external liquidity. We're going to talk about continuation blocks, and we are going to see, I'm going to show you why this works on any market. Now, the first thing, talking about liquidity. First of all, we're going to cover external liquidity. So external liquidity is every single swing high and swing low. That is it. I don't want you to watch 20 different videos on liquidity that tells you something different. I've been trading for over a decade and I found that this works the best for me. There's no point in overcomplicating your trading, everyone. So we mark out swing highs, swing lows, swing highs as well. That's our external range liquidity. And here we see on this chart, we see that a swing low has been swept. Now, what would internal range liquidity be? Internal range liquidity would be a fair value gap. Here we have a fair value gap as well that the market traded into and we rejected. Here we sweep out a low. Now we have a fair value gap above the sweep. Where do you think the market's going next? We're going into this fair value gap. We see the market trades back into that gap and we close back above the old swing low. That's a failure to displace. That is what that is. No overcomplicated BS, nothing. It's a failure to displace. In simple terms, it means price wasn't strong enough to hold selling pressure and buyers step back in. So now what do we expect? Well, if this fair value gap fails, we can expect the next swing high to be my draw on liquidity. We see that we do get that bullish expansion. We sweep out the high, but then what happens again? We fail to displace. We fail to close above this swing high. And now we get the missing piece. We get that failure to displace and we get our engulfing candle. Now, it is very important to note that the engulfing candle should only engulf the previous candle body. Here, this bullish candle, we have an engulfing candle where we engulf the wick low to wick high. Over here, we have an engulfing candle where we only engulf the body low to body high. Here we have an engulfing candle where we engulf the body as well as the wick. So now that you see this picture of price, where do you think is the higher likelihood for the market to go to next? Are we going to go down or are we going to go up? That is the question. No need to overcomplicate this. We sweep out a low, we fail to displace above a high. The next draw liquidity will be the next external swing point, and we see the market trade back down into that level. This is how we are going to frame a narrative on the daily time frame. And once we move over to real chart examples, I'll show you how do we use the 1 hour time frame to find our high probability trades. So here we have our first example on USD CAD on the daily time frame. And remember, we use the daily time frame to get our liquidity story together. And that is where 99% of traders get it wrong. They skip the liquidity story. Every trend starts with a liquidity event, and the daily time frame shows you whether the market is targeting external liquidity or internal range liquidity. If the daily sweeps external highs and closes as a strong bearish engulfing candle, where do you think the market's going next? We have a confirmed daily reversal, and that becomes our swing bias. If the daily sweeps internal lows in a range and closes bullish, we can expect a range expansion upward. This is the backbone of this entire strategy, and without this, the 1 hour chart means nothing. So here we see that we have internal range liquidity. We sweep out external, we trade up, we come back down, and we have tapped internal range liquidity. Now what do we need? We need an engulfing candle that closes above this candle's body. That would be my valid engulfing candle. Do we get that? No, we get a very aggressive bearish candle. So now, obviously, this fair value gap has failed. Where do we go to next? Well, we have this range low that the market can still go ahead and still sweep out. So we have liquidity resting right beneath price action. Now what happens? We get that sweep, we get that failure to displace, but this is not it. We need that engulfing candle. And over here we get our engulfing candle. So now, where do you think the market's going next? Well, we sweep out a low, we respect the low. What did I say? I said that the next point of draw on liquidity would be the next liquidity point. So this swing high would be my next draw on liquidity. So let's do that. Let's add a little magnet. This is my draw on liquidity. So now we can go ahead and we can drop to our 1 hour time frame. And here on the 1 hour time frame, we can look to see if we get an actual trade. Well, first things first, what do we see here? We see here that we have a very beautiful market maker buy model. We see that we have an original consolidation, accumulation, smart money reversal, distribution, potential distribution. So not only do we have a beautiful market maker buy model, we also have a sweep of a liquidity point, and we have our draw on liquidity, which would be that next swing high. Now, this is how easy trading is, guys. And I said we're going to use continuation blocks as our entries. Now, what is a continuation block? A continuation block is just an order block that forms in an expansion leg of price. That is it. No need to overcomplicate things. So here we get those down close candles that got closed above. That is my continuation block. Here we get down close candles that got closed above. That is my continuation block. No need to overcomplicate this. So here we do have down close candles. We need a closure above unless we get a new run of down close candles. So here we do start getting a new run of down close candles. We have this run of down close candles. So I need that closure above these down close candles to confirm my entry. Because remember, in a bullish market, we see that down close candles gets closed above. In a bearish market, we see up close candles gets closed below. So here we get that closure above, and this is what I need to take a trade. A very simple stop loss goes below the lowest point of this run, and our target will be that draw on liquidity. And here we can see we have a 3.68 reward to risk ratio trade. Let's see how this trade plays out. And there we go. We have hit full target. Now, this is how we can then manage our position by using continuation block theory. So we see that down closed candles get closed above. So we can go ahead and we can move our stop loss up to this low. So we can move our stop up to that level. So my stop loss will be here. We can trail it up if you don't want to take a full partial. And now we can see what price action does. Do we trade higher and close above down closed candles or not? Do we close above? We haven't received that closure above yet. We get that closure above. We move our stop loss up to the lowest point. Now again, do we continue this trend up? Do we close below down closed candles? Yes. We run our stop loss up. Do we close above down closed candles? Yes. We run our stop loss up. And we can continue this until we get stopped out. So now we can see that we are currently sitting at almost a 9 reward to risk ratio. And this is how I want you to use this simple model to catch major runs in the market. And yes, obviously it's not going to win every single time. Nothing in trading does. But that is why we have such a favorable reward to risk ratio that even with a 50% win rate, we are mega profitable. Here we have our final example on NASDAQ on NQ on the daily time frame, and we say, remember I said that we go from external swing points to internal liquidity, and we can go from internal liquidity to external swing points. Well, here we did get that sweep of a low, but we have failed to engulf the previous candle high. So we are looking currently for a sell just because we have traded back into this fair value gap, and we see that gap has respected price, and we are busy engulfing the previous candle body. So now we go from internal back to external liquidity. So with this in mind, where do you think the market's going to go next? We're going down back to this low, and we can potentially see a trade to the next swing low as well. So I will use these two swing points as my draw on liquidity. Going then to my 1 hour time frame. Here on the 1 hour time frame, we can see that daily fair value gap. Now, what do we need? We need a engulfing pattern. We need a candle that closes below up close candles, because we know that in a bearish market, up close candles will get engulfed or closed below. So you can either use this as an entry, stop loss covers that low, that high, we can go for our first target at this low, but this would be a high risk entry or an aggressive entry because we haven't received that engulfing candle on the daily time frame yet. That engulfing candle on the daily time frame only happens here. That's where my new daily candle opens. New daily candle opens at 6 p.m. So this is my new daily candle open. We see that we have this run of up close candles. We already had the reversal here. Now we are looking for a continuation block. So remember, we just need up close candles to get closed back below. So we get a new sweep of a high, and we need a candle that closes below this up close candle's body. That will be my engulfing candle, and that also forms my order block. Now this is where we can take a trade. Stop loss covers that order block's high, and my first target can be this swing low, and we can leave a runner until we have hit that other swing point on the daily time frame. So this is how we use the daily in conjunction with the 1 hour time frame to look for high probability setups. Remember that daily candle, that is our confirmation. And the reason this strategy works is simple. You're entering after the higher time frame has already revealed its intent. Your trading structure that smart money created, you're aligning daily liquidity with 1 hour precision. Price is no longer random. You're simply following the algorithm. And we can go ahead and we can play this trade forward to see what happens. We see that our first target has been met. We have secured 1.7R, and we can leave a runner running to that next swing point for a total of a 4-hour trade and see if we get that big winning trade out of this market. And in this case, we didn't get that second target. We secured 1.7R, but we have failed to hit our second target. That is why trade management is so important. And I'm not going to sit here and show you 10R winners every single time, because you do get those wonderful people in the comments that say nothing works, but those are lazy people not willing to do the work themselves. But I know you will, because you want to make this a success. Guys, trading takes some time. You can't expect to go study for 7 years to earn a master's degree or a PhD and earn a big income. Trading is on that same level. It is one of the only, if not the only job in the world where your income doesn't have a cap. You can earn as much as you want to. There's no limitations on your income. We need to know, we need to expect this not to be so easy. But with a simple strategy like this, we can see that this strategy gives us an edge over the market. Now, what I need you to do next is I need you to go and backtest this strategy and see how it performs for you. And let me know in the comments what you need help with and what your findings are. I'm here to help. And this is exactly what we do inside my mentorship. We start with the higher time frame, we track liquidity like smart money, and we execute properly on the lower time frame with precision. So if you want to trade with confidence, clarity, and an actual roadmap, a step-by-step guide with me alongside you every step of the way, go ahead and check out the first link in my description. Keep in mind, this program is a direct mentorship. I work directly with you. It is not a cheap dead-end course. So when spots open up, take it seriously. Guys, I hope you enjoyed today's video. I hope you found value. Let me know what you want to see on the channel next, and I hope you have a great rest of your day.